It's time for Under 30 as we take a look at Dish Network. Alex Coffey joined by the host of Futures, Ben Lichtenstein, here in studio. We'd now like to welcome in our next guest, and joining us now is George Tillis, Senior Markets Correspondent for the Schwab Network. We're looking at Dish, and I think we oftentimes associate this with its kind of namesake brand, George, which is, of course, sort of the satellite dish, premium satellite TV services that it offers. But this company's got investment into Sling. My question to you is, I'm sure you got plenty to go through, is they got to be sweating, I'd imagine, that YouTube TV is something that they got to go head-to-head with.
They are. I mean, if you look at Dish Networks, which traditionally it's of course the linear TV satellite-based business, its total subscriber growth is actually going down, and that's to be expected. We know that people are still cutting the cord. While at the same time, they do have a mobile business, Boost Mobile, which was actually purchased by Dish. This was back in 2019 because T-Mobile and Sprint were forced to divest certain assets, including Boost Mobile. And Dish actually bought the company based upon the approval of that particular merger. Now, this is an interesting situation because if you look at Dish, in the past 5 years, the stock is down tremendously. It's down about 83%. Even in the last year, it's down 60%. We know that based upon some of the numbers the company provided in 2022, they lost about 7% of their paid subscribers from the standpoint of their TV. While at the same time, their mobile subscribers actually fell by 9%. So there's deceleration in sales and earnings trends for Dish. But there is something interesting here from the standpoint of the value of the company, because if you look at what Amazon has been doing, they're partnering up with Dish to start to sell mobile subscription plans through Amazon. So that's a very good catalyst, I suggest, for Dish. But I think the challenge really is the company has been losing subscribers both in its linear TV business, but at the same time, as companies like AT&T and we know T-Mobile, Verizon have actually been growing. It's been unfortunate for Boost, which is owned again by Dish, that they've been losing subscribers. So I can see why it's been in a downtrend. It really is from the standpoint, even from the capacity of profits. They are a profitable business. They just happen to be demonstrating really a significant decline in both in revenue growth as well as earnings growth. So that's why the stock is down.
George, as I look at some of the selling, I'm wondering, well, some of this I'd imagine is tied to the enthusiasm associated with cutting the cord, maybe being lost over the last year or so, as many already have, yeah. Right? But also, as I look at this, I wonder, is this a stock? Is this what price activity resembles when you have a company that's kind of trying to not necessarily reinvent itself, but broaden its base a little bit and some of its offerings? You mentioned the Boost investment.
Yeah, so I think the company is trying to reinvent itself, but it's trying to reinvent itself through partnerships, which I suggest is actually what they need. I think if you consider what's going on with this particular business, they actually spun off EchoStar about 15 years ago, and now, based upon the announcement in August, they're repurchasing the company, which is basically a satellite communications provider. Now, that deal was approved by the board of directors, so you can see multiple divestitures, reaccumulation or repurchase of that particular company. The company has cash on the books. They got about $1.8 billion. They are losing cash on a per year basis by about $800 million, and the profit growth is shrinking. But they do have valuable assets, and I think that's what's interesting about this name is they're not losing money per se on an adjusted basis. They're still earning money, but they're using their cash to make acquisitions, and they need partnerships to help sustain the growth in their business. But at the same time, if you look at the tangible book value per share, it's around $34. They have an FCC spectrum, which is worth quite a bit. Their mobile and their TV businesses, satellite business, is also worth a lot. But I think the partnerships really will make a difference for this company. So this is one to watch for sure.
All righty, George, we'll keep our eyes on it. I'm not so sure. Declining earnings, a big player like Alphabet stirring around in this space. A partnership with the NFL probably doesn't help either. We'll see where it goes. Certainly having a nice day here today. George Tillis, Senior Markets Correspondent for the Schwab Network.